Dan French, welcome to the REI Diamond Show. How you doing today?
I'm doing real good, Dan. It's a pleasure to be on, man.
Yeah, for sure. I'm sure some of the listeners probably know your name or the company names and some of your history. And we're going to get into an intro and pull on the threads there a little bit about that. But I thought we would start with a quote that I saw you post on Twitter recently. And I quote, "Yesterday's goals drag us down into the pits of the netherworld."
Okay. Yeah. Double
How
click
so,
on that.
how so and why?
Yeah. Uh, I think what I meant there was, we have a tendency to get stuck in the past, and when your mind share is taken up by what you should have achieved yesterday, you don't focus on the future and what you're in control of today. So it's kind of like a demon, if you look at the Michelangelo painting on the Sistine Chapel, it's called The Last Judgment, and the bottom of the painting is a bunch of demons pulling people down into the netherworld like hell. And that's what I was equating yesterday's goals. So basically, like it's just a pivoting mindset of having the entrepreneurial um fortitude or intestinal fortitude to just say, hey, you know what, yesterday's goals, they don't matter anymore today. Like what are we achieving today, and how are we doing things better today? So that's what that meant.
And would you say in that context, are yesterday's goals for most people um, too small compared to what they're doing because they've sort of accomplished them? Or are yesterday's goals they were too large, they were outrageous, and they were, ill-informed just because you didn't know what you didn't know at the time? So maybe you're like sort of upset. Oh, I wanted to make $1 billion and I couldn't get anywhere close. And yet maybe, that's the goal. Or maybe it's like, hey, I'm making, $300,000 doing this and I made it and it's the finish line. Like which of those two would you categorize it in the way that you posted it?
I think people tend to underestimate what they can achieve in 10 years, and they overestimate what they can do in the next 2 months. So a lot of people get this wrong. So they don't have that good long-term mindset. And then when they overestimate what they can do in 2 months, and then they see that they didn't actually achieve it, they get into a malaise. They get stuck because their confidence goes down. They're like, oh man, I'm not where I want to be or where I should have been based on this goal I set up. So I think that, if you're a true entrepreneur, you're really thinking that that goal in 10 years better be really big. I like the model of thinking like so big, like 10x is the same level of effort as 1x. I don't know if that's Grant Cardone or somebody else or whatever. These different mental models are out there, but many people have said that before. So if you're going to do something with all your effort, you may as well try to shoot for something really big in 10 years. Um, because it's going to be the same effort. You're going to work the same hours, give up the same blood, sweat, tears, treasure. So go big.
Yeah, I love it. And it's funny, like I hear, the 10-year goal and people ask me, oh, what's the 10-year goal for Diamond Equity? Like I have no clue. I'm
Mhm.
trying to get through the winter right now, and I'm hoping that we come out on the other side of the election and some lower interest rates and
Yeah.
we see some seasonal spring demand, and I'll be happy and dancing a jig. Man, you take that out 3, 4, 5, 6 years and like I just have no idea. And on one hand, Dan, um, sometimes I think, at least maybe myself when I was younger, it had to be this like exorbitant astronomical goal in 10 years. Maybe it was $1 billion. I don't remember what it was, but it was just so outrageously large. And now I'm a few years older and it's like, we're in 3 cities, our company. We have a great team. There's like 20 acquisition managers working across the team, Chicago, Atlanta, Philadelphia region. We do deals virtually all over the country. And it's like, do I want that to be 40 people and 6 cities? Do I want that to be 80 people and 12? And then I have to give up, maybe more of my own time or like growth for the sake of growth, right? And like I made a decision, no, I'll double down and I'll be available for the team members I have, the partners I have to make sure that like this opportunity that we have with this current set of partners is good. And that may sound like stagnation, like, oh, it's good enough and that's that. If you're looking at it from the outside, but maybe there's more, goal setting costs rather than just the dollar or the net worth. So I've kind of had
Yeah.
that balance a little bit. And when I saw that post on Twitter, I was like, wow, yesterday's goals drag us down into the pits of the nether world. And I'm like, that's kind of true at some level. Like at one point, I wanted 100 rental doors. And there's people who have 100 rental doors. Maybe their single family houses, 100 of them. Maybe they're 4 unit buildings, and they love them. And that was the goal. They accomplished it, and that's going to be it forever. And then there's another set of people who I'm like, I'm in commercial real estate, and I have a lot of commercial real estate friends. And, their goal was 10, 20, 30 doors, whatever. And now they're like, that was yesterday's goal. And they're trying to get out of that portfolio as fast as
Yeah.
possible so that they can scale up to the next level of asset that happens
For
to maybe
sure.
be the shopping centers, the industrial. So I thought it really was cool to have a lot of thoughts spring from that one quick post.
Yeah, I appreciate it. And it's funny, I know you're in Chicago or somewhere slightly cold because you're already talking about winter. So that's kind of that's scary. It reminds me of being, growing up in the Northeast. Like, we're in early September and you're already thinking about, oh no, like I better like make the most of fall because winter's coming. But now I'm in Austin, so it's like still, it's very much summer still. So
Nice, nice. Yeah, I this year I'm gonna do a little more of a dose of
mm,
fall and a touch of winter, and we're gonna hit Florida either like December or January, and then come back in March. Last year we did like October. I don't remember. It was like 4 or 5 months or something like that down there.
that's awesome. So
Yeah,
like, yeah, getting back to goals, like that might be part of your goal now. Is like live the way you want to live and provide for your family in the way you want to provide for them. And I think it's really fun and fascinating to watch people as they get longer into their career, especially if they have kids. I have 4 kids. I know you mentioned you have at least one kid, and sometimes you have to change the grip there. So your goals are going to emerge based on your life circumstances and then also I think personally, the more that you've been given as a gift, I think a gift from God, then you have more responsibility to kind of like do more with that gift. So to help other people, empower them and what have you. So I think goals are constantly changing and emerging, and you got to always keep them really fresh.
yeah, I agree. Do you write your goals down?
I do, yeah. I have like little documents. I'm back to journaling now. I'm doing some journaling, which has been fun. I haven't done it in a while, but yeah, I like to keep my thoughts written down. Otherwise, they hang up or they take up too much real estate inside your brain. So you got to like put them somewhere and come back to them, refine them.
Yeah, it's easy to delude yourself if you keep them all in your head.
Exactly. Yeah. Yeah. Totally.
They kind of change. I've been writing my goals down for consistently. Almost, I do it on a weekly basis. So my journal consists of, a page on the left, page on the right. The page on the left is weekly goals. Toward the bottom of that page is like yearly and then 5 year goals. I never, the 5 year goals they're far fetched, they're vague, they've changed over time. The 1 year goals often are going to kind of dictate the weekly goals. And then the weekly goals is a
Yeah.
bit of a to do list, right? It's like, I hope I get these 6 or 7 little goals done. And now on the right hand side is my to do list for every day. So each night I'm sitting down and I'm putting tomorrow's 1 or 2 or 3 really important items on there. And like that right side of the page, it's a limit. It can never go past that one page. You can't turn the page and put all these horseshit goals on
Yeah.
and on and on and
I
on and
love
on
that.
just to get. Yeah, so it's like the restriction of it, and then that weekly ritual of doing the goals. Start on a Friday, and it'll go through Saturday, and then Sunday, and
Mhm.
I'm constantly refining and adding and taking stuff off of there. But it's interesting to see like week after week after week. Sometimes the stuff is getting knocked off. Other times I'm having to transfer the same weekly goal week after week. Man, I'm not getting that thing done.
Yeah.
Maybe I just
That's
need
super. Yeah. That I love that, and it's almost like you're your own accountability partner at that point, right? Like you're keeping yourself accountable. And so many people just go through they don't trace their time or they don't track their weekly stuff, and then they're surprised in a month or two when they're not where they want to be. It's like, well, you're not tracking it, and you're not pushing yourself to the limits of what you can do.
And the interesting thing, I guess, now that I think of it, is on that one page, there's however many lines that has to be the 7 days of the to-do list.
Mhm.
Every single day, going back to 2011 when I gave my life back to God, the first item for every day is thank God. So
Mhm.
I've already used 7 of those lines in the restriction method, and that goes all the way back. And I have all the books saved. That's like one thing I'm, my family, I guess after I die, maybe they'll just like chuck them.
Yeah.
Chuck
Or
'em in
maybe
the
they'll
garbage.
immortalize it by actually writing it out on, and like publish it in a book or something.
That's
Yeah,
right. That's
you
right.
never know.
So, some of the early ones, but I
Mhm.
digress. So let's shift gears a little bit. Can you give us a synopsis of kind of the real estate career, what you've done, and sort of where you're at right now?
Yeah, so I started in real estate 20 years ago. I was, a year out of undergrad, let's say. This is like 04, 05. And so I graduated in 03. And my business partner, who I'm still in partnership with, his name is Pete. He got his brother's name is Rob, and I grew up with these guys. So they were starting up a small real estate partnership to go buy really small multifamily deals. And in fact, I don't even know if they're considered actual multifamily. It's like 4 unit buildings, 2 unit building, this kind of deal. And I immediately said yes when they approached me because I had it somewhere in my heart that I wanted to create future wealth for a family I didn't have at that point. But it was in my head, like, real estate is definitely a tried and true path to wealth creation. I didn't know that much, at least, even though when you're 23, you know barely anything. But I did know that, and I also knew having a college experience in a couple of different apartments that I'm like, man, there's something here, and I think I could do it better. You get the classic experience of just you never can get a hold of your landlord. They're doing as little capex and maintenance work as possible. It's pretty run down, and it's just not a good experience. I'm like, man, people should be treated better than this, and I think I could, if I had the chance someday, I would be able to do that. So, and also my two business partners are like superb human beings with a lot of integrity. So and hard work, work ethic. So I said yes, and we, for a couple of years we felt really smart in real estate. We got up to a couple hundred units, and then the GFC hit us, and we got like almost completely wiped out, almost bankrupt, and but just fought tooth and nail to kind of like scratch our way out of it, not making any money out of it, but just like not getting foreclosed on, not getting bankruptcies. So we made it through that storm, and by 2011, I was ready to join my partner full time. So it's a bit more complicated. I had a different career as well concurrently to doing this. I was in public service. I was an elected official in my 20s. For 7 years straight, I held elected office from 23 years old to 30 years old. So one of the reasons why when I was 30, I joined up Pete full time was because I lost my election for a much higher office. And 3 days later, I called him up and I was like, I want to join what you're building now, which was a completely different firm. That old partnership was done. And this firm is the one that bought $2 billion of total asset value. Now focusing on Florida and Texas, all multifamily deals. And it was a wonderful ride. And I became CEO of that firm in 2016. By 2019, the firm made a really hard pivot away from the buy side. We shut down our buy side and we sold. We became net sellers, and we sold $1.5 billion of the portfolio. We pivoted our property management team to become a third party provider. And so we've actually grown that back up to 15,000 units that we manage, which is pretty sizable for the audience out there. In the multifamily space, that's pretty sizable. So to be in the top 50, you would basically be at like 35,000, to put it into perspective, top 50 in the US. So, and then along the way, we've done real estate technology. We launched 10 tech companies. And let me pause there because now I've shifted over to be a partner in all the businesses. And I'm no longer operating day to day with that team, but still a partner, still incentivized, motivated to see them succeed, and still advising. But it's a big change for me.
So timing the market to get out in 2019, what was the trajectory? Was that like a 4-year sell cycle there, or were you able to? How long did it take to sell off 1.5 billion?
Probably 2.5 years, because we didn't do it as a portfolio. Of course, we wanted to maximize the value, so we did it deal by deal. So it took a while.
And each deal is about how many units on average?
150 to 250,
Wow.
you know, some of them bigger.
What was the
Um,
vintage? Were you guys very tight with maybe the year built, or were you kind of like anything goes?
it became an emergent play over time. So in the beginning in 2011, uh, the firm was buying a lot of bank owned assets, especially in Florida. Florida had was like truly devastated during the GFC, much more so than some other states, especially Texas didn't have the same kind of recession that Florida had. Florida was much more was hit a lot harder. So the banks wound up taking possession of deals, and we would just buy them directly from the bank's REO schedule, like their real estate owned deals that they don't want to own, right? They want to get it off their books. We would buy them at crazy low basis, but they're heavy turnarounds. So that's how our firm emerged, and we got really a lot of scale doing that. And they were very heavy capex plays, like turnaround plays. And over time, we kind of got into this like B asset to B plus play, the more typical value add play. Um, but that happened in later years. It kind of like happened over time, if that makes sense. So
And
by
maybe those BB plus assets are like 10, 15 years old, kind of doing a refresh. Is that accurate?
yeah, we did back then we were doing 70s in the beginning, then we did 80s and we did 90s. So that was our typical play. And then later on we bought a couple out of lease up. So we had a 2017 vintage, we had some 2000 stuff, but where we I think really focused for the most part of that 2 billion was this kind of 1980s put in $10,000 a door on capex, and then bring the spec up and kind of get retenant a little bit and do the traditional value add play.
Do you remember the number of properties in the $2 billion fund roughly?
It's an easy number to remember. I think it's 100.
That's
Yeah,
it, huh? Yeah,
yeah.
wow.
Some of them in the very
Well,
beginning were
that's
small,
it. They're 200, 300 unit buildings. That's it.
right? Yeah. So some in the very beginning that's part of that track record were smaller. So they were more like proof of concept deals that were happening, maybe 30 units, 40 units. And then, eventually we just only bought bigger deals because in the multifamily space, it just makes sense to buy the bigger deals.
So, in terms of timing the market here, Dan, I mean, was this like an inspiration from God and someone woke up and was like, Moses with the tablets came down?
Yeah.
Like what precipitated the conversations and how did you guys come to the decision to pivot in 2019 and then start selling? Because looking back, 2019 is not maybe the most obvious time to say, here we are at the top and things aren't going to get good. And then if we fast forward to 2022, or 2021, let's say, there's probably a moment where you and your partners are like, oh man, we missed the top. We could have sold this for that much and the interest rates are low and we got rid of so. And then 2022 came and the large multifamily apartment deals are not doing anywhere near as well in the current moment.
Yeah.
It's a buy cycle right now. And then you guys look like geniuses now looking back. So like, how did the conversation and the decision to pivot come up? And maybe there's like even my partner said this and I said that. Give me some detail
Yeah.
there,
You
Dan.
want some juice, huh?
That's
No.
right. That's right.
Yeah, good point though, because yes, there was moments when you could be like, no one ever times it perfectly because even if we sold the deal in 2019, well, imagine a world where you sold it right before rates went up, right? Which maybe was like the frothiest point of the market, like right before, a couple months before, when the money is like flowing and it's crazy and there's all this exuberance. And so yeah, you can always drive yourself nuts by playing those scenarios out, but how it came about really I would say is actually credit to Pete. So that by that point he's the founder and my partner. He's executive chairman, so he's a little bit more detached from the day-to-day stuff, but in a way that's good because then he can focus on more like seeing trend lines and he's still very in touch with the business clearly, and in touch with all the capital allocation decisions and buy, sell, refi, anything like that, portfolio management. So he called out like, and we were discussing this as an executive team anyhow, but when you're underwriting deals and it's just no way to pencil those deals by 2019, with a conservative approach. And we had a superb deal shop. Like many of them have gone on to do incredible things on their own after emerging from our firm. And so the deal, it wasn't like we didn't have alpha as a deal shop, and it wasn't like we didn't have broker relationships. We simply didn't want to pay what the market was paying at that point because certain intrinsic value metrics were being, you're above the. So example being, if you're buying above replacement cost, that's a really bad signal. Like you don't want to be doing that. You want to buy below replacement cost. And so we just thought, and this is for like a typical 80s deal in Florida. Like it just doesn't make any sense. Like it's really hard when you take a step back and when you're removed from that day-to-day, the grind of the day-to-day. That's where Pete came in and said, hey, maybe we should just, instead of buying into the froth, sell into the froth. So that's how it came about. And then over a couple months, it became a hardcore, like besides our most prime, well-located assets that are like forever hold mentality, let's sell. So it became like, we should slow down the deal machine to a let's sell everything non-core.
So you're kind of pruning off. 1.5 billion is a prune off, and the other remaining half a billion. I mean, what are we talking here? Is that like 20, 25 properties that's left?
No, not quite that much, maybe 10 properties, something like that.
Much larger, maybe newer vintage. We're talking about a little
Yeah,
bit easier
yeah,
to
better
manage.
locations. Yeah,
Yeah.
yeah, good, exactly, easier to manage. There was a plurality of things we looked at to say like this one is a more of a put in a forever hold position.
Yeah, it's funny. When I was doing the research for our episode, something I wrote down was like the life cycle of an investor. And I noticed this in my own buying pattern, and I try to guard against it. I notice it in buyer activity in the market, not really like residential buyer activity, but investors. And you start in the business, and if you're going to be successful long term, you got to buy it low. But eventually, the market, when it reaches that level of froth, now you're too cheap and you can't get deals, and you're faced with the decision: do we buy higher? And some guys do that, right? Somebody I know bought a bunch of properties high, is stuck in a really bad development. This is a big name in one of the markets. I'm not going to mention it because it's like kind of hush hush and secret the way that the properties are now being like disposed of. But he bought in too high. It's kind of the developer's trap. Go bigger,
Mhm.
bigger, bigger, bigger. And if you're going to keep participating, the parcel that sold for 10 million in the core of the city is suddenly selling for 29 million toward the end of the cycle. It's probably going to sell again for 12 million after it cycles through now because the price of land falls so hard. Now, the developer made probably several buys of that nature over time and got away with it as the froth continued. And maybe that was a 5 or a 10 year period to sort of rationalize or reinforce this non conservative approach, this more riverboat gambling approach
Mhm. Yeah, yeah.
versus what you described where Pete had this metric of, you guys all had the metric of not paying above the replacement cost because that was where it started to get dangerous. And I love that as a signal in the market because what is probably happening, you could correct me if my assumption's wrong, Dan, is you're saying you're seeing no deals in the market, but that's probably not just like, oh, we're seeing things. What's happening is broker brings you the deal, you guys underwrite the deal, you guys put your offer in there, but then they get 15 offers above yours, and the top offer maybe can't close, but the number two from the top closes on it, and you're like, how did they pay that? How
Yeah,
did they make it work? Right? So you're seeing the
exactly.
transactions. uh they're transacting, there's price discovery, there's a closing, and there's real evidence that the deal actually went down, and now you're like, there's no way they can pencil it. They've paid too much, but your offer was still in the ring, and you're not getting a success. I love that as a signal to sell in the market,
Yeah,
when you're seeing that over the long haul.
exactly. Yeah, and every day you don't sell, you're buying it again every single day. So that's another good mental model. It's keeps you disciplined. And then also matching your maturities with your, your hold period. I think a lot of people gotten in big trouble with floating debt here because they thought that the go-go days were kind of forever, and they kept putting floating debt on deals. And then that's been one surprise I would say over the last year. Our thesis of getting back in on the buy side was that this is going to turn into distress. Between rising costs, property taxes, insurance, labor costs, obviously, but then too many people with floating debt. Well, something doesn't add up. People are going to have to exit their deals at much lower prices than they want to. And if they bought at the peak pricing, the pain is just so high. But for whatever reason, I think there are many of them, it's played out like really slowly. And we thought it was going to play out a lot faster. So it's been a really interesting. That's why you can't tell. You can't really, no one can truly time this thing. So if you're a market timer, you're kind of fooling yourself, I think.
So we have, you mentioned the GFC. For those that don't know, that's the great financial crisis that we had in 2007, 8, 9, 10, 11, packaged those years when the market blew out. And I was living in Miami for a short period right after that. So it was probably November of 2009. And we're at a complex on the water in Miami, and we couldn't figure out what the hell happened there. We went in, and the doors are open. We're like walking around this eerie 150 200 unit apartment. You guys probably bought this property and rehabbed it.
Is it on Collins? No, I'm kidding. Yeah, go ahead.
No, it wasn't quite that nice of a location, but it was like, it was like such an odd feeling. We were trespassing in there, and it was just like so cool to go in. We were kind of looking for deals, but it was way above our weight class at the time.
Yeah.
And all the toilets were smashed. Any vanities and fixtures, they were all smashed like with a sledgehammer in all of the units. All the walls were smashed. Yeah. All the wires were cut. And I'm like, how did this happen? It's not like, an abandoned building. And then later, when I kind of learned as the great financial crisis unfolded, the banks simply would not give you your next construction draw. So they would have $3 million of your money that was already approved sitting in the loan and escrow, and you need $500,000 to pay the contractor who just put in all the toilets, and he doesn't get his money. So either the owner's like, you know what, we're going to go destroy the asset, the bank's going to be beat. Or the contractor was like, you know what, we're going to go in there and destroy the property.
Revenge. Yeah.
Yeah. So it totally filled in the blanks, because it's like, homeless people don't do that kind of destruction.
Yeah. They're not that organized. Yeah.
True. Yeah. We'll put in that much effort. I mean, we're talking at least 100 units of destruction there.
That's wild. Yeah. That gave me flashbacks to this. People will pull the copper out of buildings, and sell it somewhere. Just total, city blocks of certain areas, they'd just be left for dead. And the buildings were just sometimes it's fenced off, and sometimes not, and just people just roaming through the places. You're like, what is going on? So if you didn't live through that, it's really hard to imagine that in Florida right now. So when people talk about distress, it's not the same level even from a financial distress standpoint, let alone a physical distress standpoint. It's just nowhere. You can't compare the two. What we're seeing now versus the aftermath of the GFC is totally different.
Correct. And I think maybe the lessons, let's say the lenders probably walked away with, was, we're not going to stop construction and jeopardize the asset, right? So I think there was a lot more willingness to work out loans so far that we've seen. So the distress is probably harder to find. It's not everywhere you look. There's actually a lot of dry powder, meaning like the buyers are ready to step in and buy the assets like instantly. And we're not talking about completely vacant apartment buildings. We're talking about, apartment buildings that even are like 90% occupied, but that the maturity date, the refinance is due for the seller. And they're going to have to either bring more capital to the table, which they can't go back for a capital call just to save the asset. And so the deals I know of that have gotten, it's just they wiped the equity. They basically sold it for the loan amount. Every passive investor, took a complete and total loss, and the person just got out from under the debt, and the
Right.
assets were beautiful, totally renovated asset. Almost full market rent. There's like not much value add there, but the person who stepped into it basically stepped into a fully stabilized property. Now their cash flow is probably not great because we're at 6.5% interest.
Right.
But I think, as supply continues to tighten with the lack of new construction and as interest rates level off, they're suddenly hanging on to or in possession of a quality asset for the long term. And those are the handful of deals. I mean, I'm not studying the multifamily market probably the way that you and the team are. So these are anecdotal through conversations with friends of mine that I know of these deals that happened, but they're few and far between, like you said, compared to the GFC. It was like you didn't have to go very far to find
Yeah.
6, 10 deals to look at.
No, what you pointed out is actually perfect. So if you think about pricing came down 25 to 30% off of the highs that we saw before the rates went up, right? So, but that makes sense because your debt service has gone way up. So what you can pay for the building needs to go down. But let's say it's 25 to 30% below. Well then yeah, if your debt was capped at 70%, let's say, and you didn't do this exotic, ultra high leverage of 95% that people were doing back then, well, then, that's a bad day for LPs and for the GP who had their money in there too, hopefully, because that 30% wipes them out. But 70%, you're right, it's totally, it's backed by the asset. So the bank is like, all right, well, at least I got my loan, the dollars I put out as a loan, I got it back. So that's why you're not going to see the physical distress of stuff being left for dead, you know.
And
That's
I'm not sure we've seen all of it cycle through yet either.
Yeah,
Like you
yeah, we
said,
have.
this one is a whole lot slower than the GFC. So I'm curious, Pete, you and Pete were doing business during the GFC. You guys got hit pretty hard, almost to bankruptcy.
Mhm.
What do you think the lessons were for you and Pete, having lived through that, to pick in 2019 as, the pivot point, if any, right?
Yeah, yeah. I think, well, first of all, the key lessons were, pick your market. Yeah, do a much better job picking your market because the market's going to do a lot of work for you. And the original stuff we bought was in a small market, low growth, not very dynamic. So you gotta have the market at your back. So you want to pick that well, and then you also want to pick locations. Do a much better job picking locations. That sounds super obvious, but when you're in a tough neighborhood, guess what? There's certain things about that neighborhood where it makes it very sticky. The turning around a neighborhood might be like multiple decades. You might come back there in two decades and be like, wow, not much has changed here. Like, and as an investor, sometimes in the early days when you're not as schooled to this, like you think, oh, you're going to be part of this turnaround story, but oftentimes you just get turned around, So that's that's what we figured out, and then we took too much leverage, so
In the
we were
GFC.
yeah, but before the
Okay.
GFC, we were the guys taking as much leverage sometimes as we can get. So then your margin of safety is not there, and you have no room for error. Like one tenant or resident not paying the rent on time, you're like, oh, what do we do? So
And did you guys, was there so what worries me at the moment is credit card balances across America are basically at record high. Savings are back down to, I don't know if it's a record low, but the savings are way down. Um, so we have, not as much job creation as we actually reported all throughout last year, right? They had to go back and revise the numbers. So there's just a lot of these little tells that the economy is weakening. And, in commercial real estate, retail rents have been strong and retail has become a darling. I own a shopping center in Las Vegas right now. We're getting, great, phenomenal rents. And we're full of a lot of local tenants. And they seem to be good and paying the rent and have traffic there. But what worries me is what happens if the round of layoffs and the next round of layoffs and the next round of layoffs affects the dollars being spent in our local tenants' places, and they start to go dark, right? I have this
Yeah.
risk of, the tenants can't pay the rent, and then we have falling rents, and then because of the falling rents, there's two compressions of value in the commercial real estate. Number one, when the rents are falling, the cap rates are going to expand. People are going to want a higher cap rate, and they're going to
Yeah.
want to pay a lower price for the same income stream because they're not seeing 2.5, 3, 4, 5, 10% growth in the rents where they can justify paying above replacement costs like they could 3, 4, 5 years ago.
Yep.
So I'm wondering, did you guys see, kind of a large uptick in tenant defaults during the GFC, and that was part of the pain for you guys? Or was it like literally just one or two tenants kind of fell off and it was more the debt? Like, was it more the tenant's ability to pay or more the debt structure that really kind of put the pressure on you guys when you were in that situation?
No, it was primarily the former. Is the residents couldn't pay, and they were the ones that was servicing all the cash flow. Like, we didn't really have like a lot of reserves, right? We didn't think about it like that. So being inexperienced, you just pretend that everything's going to keep going the way you want it to go, and then when it doesn't, and you're in trouble, right? And there's no way you have so much leverage. What are you going to do on that side? They're going to want to get paid still.
Yeah,
So
that's right. Yeah. And that was the story. I had is it Rod Cleef, I think I had on, and he had $50 million worth of single family houses all over the Fort Myers area at the time, and ton of debt on there. He talks about this publicly, so I'm not sharing anything he wouldn't share himself, and he shared this on our show here actually. And he said that it was the tenant base that he was renting to was kind of the blue collar. He's buying in the blue collar areas. And those were the same people who were likely working on that apartment building that got destroyed that I talked about, right? It's like those
yeah,
are the plumbers, electricians, and painters. And now all of a sudden the rug was completely pulled out from under those tenants, and they couldn't work anymore for the same reasons that the rest of the assets and the banks simply wouldn't give the next construction draw, and
yeah,
it
for
created
sure.
just a perfect storm. So he had to hit the reset during that time.
Mhm.
Yeah.
Yeah.
Um, yeah, interesting stuff here. So tell me about property management. Before we started the record, you were excited about property management and to put together a $2 billion portfolio with 15,000, it was 11,000 units maybe in that portfolio with 15,000 under management. My head is spinning. Like, what is the structure of that? I can't even, my property manager probably has 180 units and like 40 of them are mine. How the hell do you build something that manages five figures worth of tenants?
Yeah, well, first of all, I think to give credit to what people that are doing 180, what we would call, I would call them snowflakes, right? They're dispersed, right? This is single family rentals that we're talking.
Theirs are probably, yeah, mine are a couple
Oh,
apartment buildings. They're probably on the big end at 15 units.
oh, I see. Okay. Yeah, so I was gonna say the one at a time, like they're scattered, and so it's a fragmented thing, and they're snowflakes. So they each have their own roofing, mechanical, electrical issues. They're all different. Now, not to say that large multifamily property management's easy. It's very difficult, but when you have a 300 unit apartment community, there are economies of scale that happen there, because it's one facilities, one mechanicals, and all this stuff. But it's very difficult. It's extremely competitive. That's one thing to think about. It's like, man, owners actually nowadays have more offerings on the third party management side than ever before, and many of them have private equity behind them, so they're looking for scale. Some of the big ones are the Gray Stars is the biggest, like 800,000 units, but some of the other big ones are like at 300,000. And they have private equity money behind them. They're doing roll-ups of other property management companies. So it's an extremely competitive space. And how you build it, there's no one answer. You just have to build as you go. And some of the things, one idea I have, by the way, is to write a book on how to build a multifamily property management firm, because that book does not exist at all. If anything's written about property management, it's like, property management for dummies, which I don't like that title, by the way. But those are the books out there. It's like, well, here's how you move in a tenant. Here's how you move out a tenant. here's what, here's fair housing. Like that's not a book I would ever seek to write. It would be more like what you're asking. Well, how do you build a company? And I think the answer is like, how do you eat an elephant? You take one bite at a time, you know? And every time you get bigger, like almost every 3 to 6 months, if you're growing, you're a brand new company.
Hmm.
That's how I look at it. It's like you have to almost break your old processes every 6 months, create new ones, and then you're a new company, and then you kind of scaffold on top of that. So that's I would say how we've done it. And and I like to also tell people like get ready because you're think of yourself as a staffing company because
Mm.
that's how much unfortunately how much churn there is in our industry. 60% retention rate is considered really good.
Strong.
Like that's super strong. Yeah. So you're on a constant like treadmill of people, especially on the maintenance side, that are coming into your property management team. They're coming out. They might get an offer for 50 cents higher at a next door property and they take it, you know. So you have to build culture. Like, why do people stay? Well, they see that there's growth. They see that you care about them, that you care about their career path, that you train them well, so they can see like, all right, the next step in my career is to become a super. I'm a tech now, so I know if I stick it out with this company, I become a super. Anyway, I'm kind of spitballing here, but you can see it's very complex. I think there's no one good answer. I think you have to be prepared to do like 1,000 things and do them all well.
Yeah, when I hear you talk about it, and I don't even want to like go deep into details of it, I'm like, I just appreciate my opportunities to be the LP in a lot of my projects. Like even at shopping center I alluded to, I don't want to read all those leases. I don't want to have to like pay the taxes. I don't want to like do all that stuff and pay attention to it. It's just so relieving. Look, I mean, I'm busy doing the details of diamond equity, so it's not like I'm just sitting on my ass with my feet up, sipping margarita. And I don't drink. I haven't in 10 years. But like, I'm not the guy with the, dream of sitting on the beach with the umbrella drink. That's not like
The
me.
daiquiri. Yeah.
Yeah, yeah, that's not why I like the LP things. I just appreciate having the opportunity to put my money to work with a team who has maybe spent 5, 10, 15, 20 years, probably more like 10, 15, 20 years usually, figuring out the nuances and getting punched in the face lots of times already. So
Yeah.
that by the time I show up and put my money in, we're talking, collective 40, 50 years experience, maybe in the executive team alone. And they've got the staffing and the maintenance people and all those kind of things in place. When you guys, I mean, this is a good turning point for us, but the investment capital stack here, did you guys go private equity to really try to streamline these deals, or did you kind of syndicate these deals with high net worth individuals? Like what was sort of the capital stack to get to $2 billion in property?
Oh, on the buy side, yeah. So
Yeah.
we in the beginning was very much syndication deal by deal, and creating a really great network of high net worth and ultra high net worth individuals who would come into our deals. And then later on, I think by 2014, we created a GP fund, so general partner fund. And so some of the partner money goes into that, but then we also take alongside us LPs who want the fund, and that diversifies them across all the deals we buy during the time when the fund's open. And then deal by deal, we'll also do a sidecar. So the GP fund might be 10 to 30% of each deal, and then you're raising the rest with LP capital that might just want to go into a specific deal versus the picking a fund, which is they don't get access, they can't say yes or no to a deal, right? They're just along for the ride. Over time, we did some JVs where the LP check was 90% and the GP fund was 10%. So we experimented with some of that. There's pros and cons to doing everything. So that's one of my great learnings is like, man, where your capital comes from is really, it's so important because it's there's going to be pros and cons.
Did you guys accept institutional money at all along the point, or did you guys literally know each individual investor?
No, it was institutional. Like that when you get up to that 90% check writer,
Yeah,
that's
family
it's
office kind of
yeah,
thing.
it's family office or mid market like private equity shop. kind of deal. We were chased by a couple of the bigger, much bigger names that we actually said no to. We got down the line on a term sheet with one or two of the really big names, and they wanted to kind of like take us to that next level and buy 10,000 units together, but
Hmm.
we wound up not doing that. So
Very
again,
good.
pros
Very
and
good.
cons to everything. So
Yeah, the fun with the LP sidecar, that's interesting. And it's interesting that you were able to get to $2 billion without, one or two of the big names kind of
Mhm.
stepping in and doing that. So it's very congratulations.
Oh, thank you.
Yeah, very cool. Okay. So we touched on, I think, early in the episode. What do you think is going to be next for you, Dan?
Ah man, I gotta create a diamond, man. I don't know what the diamond is out there, but I like to say, by the way, I like the name diamond. I always tell the team pressure makes diamonds, you know. So when there's times of high pressure, like don't look at it like, oh, it's what was me and this is so hard. Like look at it like actually, no, this is formation. It's forming you into a diamond. So for me, what comes back to me, I could do something strictly in real estate, and that's that's where my domain expertise is. But I'm also thinking it keeps coming back to me like this idea about blue collar workers out there. The U.S., think about baby boomers are retiring at such a crazy rate, and a lot of them are the ones that own these businesses, like these blue collar businesses, and their families are not stepping in to take over the business. So you're going to have all these businesses change hands. Maybe they get bought, maybe they just fade away. But it leaves a huge gap in the American economy. And so one idea I have is why don't we have a way, almost an incubation platform, where we take people who should become entrepreneurs, right? But they're too scared. It's too daunting to figure out like, well, how do I set up an LLC? How do I set up my accounting, my back office, my AR, my AP? How do I do all these things? So one idea I have is like tool them up, and I have some. I'm not going to bore you with all the details of how I would structure it, but convince these people like, hey, you know what? You don't have to be a W-2. You can actually be an owner. And it's going to be hard work. And here we're going to have you give you the guardrails and give you motivation and coaching and accountability. We're going to help you set up your back office, but then you're going to go do it. I think that's pretty cool. I don't know. I'm really pumped up about it. I don't know if I'll actually do it, but someone needs to do it.
Yeah, I think you're right, and I think that there are issues, from what I understand, with people going into the trades. Right, college is like sold as this like one size fits all, success pill to our youth, and they don't have as many people raising their hand to go into the trades. I think that's a big challenge. I think to go into there are a few companies I saw doing something like this where they had like the HVAC tech school, and that
Mhm.
was like part of it. Now they're paying, the owner of the HVAC company is paying for this tech school to like train their, future employees, and a future employee maybe owes them 2, 3, 4 years on the exit. So you're having to almost like grow these careers from the ground to replace them. So if you're dealing with 60% retention in the staffing here, I think those same companies are going to run into that challenge as well. And it's funny that you mention it, because I had an idea about like shopping centers or flex retail spaces, and I was like, what if we could kind of have a property, a 200,000 square foot property, and we're going to have these tenants move in, just like, let's say, my 80,000 square foot Vegas shopping center.
Mhm.
And like, as part of what we're doing in this like real estate fund, we have the real estate, so the economics of the real estate are going to make sense. But we also have this uh, business mastermind that we're like kind of introducing some of maybe the owners to, so that we're having that opportunity to teach them. Right? It's like maybe we're not having to form the LLC and put his payroll company together. Maybe he figured that out, but maybe he's not, or she's not thinking about maybe the next level of like marketing and business strategy and things of that nature, so that the person who starts in 2,000 square feet of the flex space suddenly needs a shopping center built later. So I think it was,
Yeah, exactly.
yeah, there was, who's the big developer? I'm drawing a blank here. Trammell Crow.
Mhm.
So Trammell Crow bought a trucking company, and he had a warehouse incubation business, and he would rent out little corners. The guy only needs 3,000 square feet for his boxes. And his reason for doing that, obviously, he was getting a higher square foot per square foot rent for sure on the little space. But
Yep.
like, his model's multi-billion dollar. He didn't care about eking out the extra 20%. His thing was more, I have this trucking company help this person implement their logistics at a higher level, and he became this like growth catalyst. And suddenly the person went from 3,000 to, I need 100,000, can you build it for me? So he
Right.
had tenants sort of packaged right in there, and he had this like compounding flywheel, I guess, that had a business model in real estate there. Because
Hmm.
look, if you can capitalize the real estate and you've got the tenant, there's going to be a very big payday there versus trying to like make the $2 off every cheeseburger that's sold out of the, front window of the shopping center, right? So,
Exactly.
yeah.
Yeah. Yeah, that's cool. Yeah, look, I think there's a structural gap in the US for sure of not enough blue collar people who know how to work with their hands, the trades. It's going to be an enduring gap, and AI is not solving that. There's no robots coming that are going to go do plumbing work or electrical in a building anytime soon. Probably maybe for the next 100 years, whatever. So someone needs to tool up more people and then use better technology so that way that industry becomes more productive, because that's another way to do it too, right? You need fewer people if everyone's more productive. So
Yeah. And it's like, I look at real estate, and you're doing a deal. A shopping center is like a small business. We buy it for 8 million, we put in 2 million, we tenant the thing up. It's worth 20 million when it's all said and done. But like, make no mistake about it, that was a business, and it had to be executed over 1, 2, 3, 4, 5, 6, 7, however many years
yeah.
of running that business, controlling costs, collections on the rent, the whole thing, to get to the exit where usually maybe the big windfall of money comes from, or the refinance if that's where it comes from.
Mhm.
But if you look at, and this is like Alex Hormozy, like we were talking about before, Dan Kennedy, a lot of the business people, the businesses, right? The real estate, a lot of times, you can only push the price for the apartment from 2,000 to 2,100, and that's probably a decent push. And you're going to lose some tenants doing it. But you could take a business that's making, 60, 80 grand a month, and you could put better marketing and more efficient software in place, and push that from 60, 80 grand a month within a 12-month period. Maybe you could get that to $250,000 a
Yeah,
month.
that's a good point.
So
Exactly.
the value drive in doing business successfully, it doesn't seem as clear a path to me necessarily, looking at it from the outside, and that's not really my specialty. As real estate is a clear path. I put in a kitchen, I put in a bathroom, I put a roof on, I paint it, I plant flowers, and I put a for sale sign in the lawn, and I make my money.
Yeah. Right, right.
Yeah. I mean, it's creative. Don't get me wrong. There's a lot of creativity that goes into
Yeah.
designing apartments and everything, but the universe of options when you're running a business to consider to really move the needle is infinitely more complex, I think, than the average real estate deal. So,
Yeah. Fair. That's a good point, man.
yeah, but the upside. So let's
Mhm.
shift gears here as we wind this down. I ask most of my guests here, I'm interested if you have a book recommendation or two, it could be real estate related or otherwise, that you might share with our listener.
From an investment standpoint, I like the Warren Buffett shareholder letters. If you just read all of them, there's over 50 of them now. I mean, it's just phenomenal. You see great investment advice, but you also see some of his plays, emerge over many, many years. He's owned the same business and why he keeps owning it. It's awesome.
Hmm.
Yeah, I think that's a really good one. And if you're looking for a management book, I like High Output Management by Andy Grove. I think that's one I've read maybe 3 or 4 times. I read it like once every 5 years. It's not a big book or long book, but it's really it helps you think about how to manage people, train them well, motivate them. So
Nice, solid.
yeah.
If you could go back 2003, 2004 and share the crown jewel of wisdom with yourself, knowing everything you know now, what would that be, Dan?
Oh man. I would probably give myself some business advice, but I also say, hey, be open to getting married earlier. I think that's an interesting one for kids to listen to and hear. I got married when I was like 30 and been married for 12 years, and I just felt like more supercharged once I was in a marriage and had started having kids, and I just felt like I was hitting new levels. And also work on yourself, man. We're just constantly working on yourself, your faith. Don't forget that as a component of who you are. Like, um, but anything you invest in yourself will become the best investment. Buffett says that too. It's like the best thing you can do is invest in yourself, invest in your mind.
It's funny that you mentioned the wife. I'm getting married in 2 or 3 weeks here. The countdown is on. She
Hmm.
wanted she wanted like let's go to the justice of peace and do it ourselves. And I was like, no, no, I want like a whole thing, but you have to plan it.
Yeah. Yeah. I don't need
um,
to pick the colors of the flowers. You go ahead. Yeah.
That's right. That's right. But I do want the you yeah. So she's been working on that. But in the book of Proverbs, which I read like if today is the fifth, I read Proverbs chapter 5 today, and
Hmm.
tomorrow I'll read chapter 6, and I do that every day, and it repeats over and over. It's like a little tuning fork for my spirit. That's how I live. I can't remember where it's at. I think it's around 30 or 31. But it says that he who finds a wife is going to receive blessing. It's something along those lines, and that's kind
Yeah.
of like what you just described, right? It's like this. I don't know if it's like the grounding rod or the supercharge, but I certainly
Yeah. Yeah.
noticed that even though I'm not married already, we've been living together, and my life has gotten tremendously better with Katie in my life now, and I can't wait till the wedding. And yeah, I guess
I
Dan,
hope it's a great wedding. Yeah.
thank you.
That's
I
awesome.
guess it's hard though. It's like, get married earlier, but we weren't the people we were supposed to be for the person that God was working on too until we
Yeah.
met, you know?
No, no doubt. Yeah. Yeah.
Yeah.
Yeah. That's a whole different podcast. Yeah. Yeah.
That's right. So where can listeners go to find more, maybe reach out to you?
LinkedIn is great. Daniel French. Check me on LinkedIn. I'm fairly active there. I post pretty much every day. I also give out my number. It's 845-629-1808. My number's on LinkedIn too. If you want to look me up there, just under the contact info. And yeah, I want to share ideas with people, especially now as I'm seeking like my next big play. I just would love to share ideas with people and see what they're thinking and bounce ideas off of smart people. So.
Nice. And my final question, what is the kindest thing anyone has ever done for you, Dan?
I'm a man of faith. I think God just gave me the gift of life, and all the gifts that He's given me is, I don't know if you can call that kind or just whatever that is. It's the most miraculous thing. But then my parents, I have to say my parents, and the kindness there would be belief. I think they just always kind of told me I could do whatever I put my mind to, and then if you hear that enough, you start believing it, and yeah. Because at first you're like, oh man, I don't know about all this, but then they believe so much in you, and that's what it takes, right? Someone to believe in you. So
Yeah, I agree. I heard those same words growing up. Praise God. You can do what you want, be a leader. Yeah, mom and dad.
yeah,
Well, cool, Dan. I got a couple pages notes. I had a blast here. I really appreciate you coming on the show.
that was fun, man. Thank you.